Welcome to the Finance Wisdom Summaries.
The Essays of Warren Buffett, Lessons for Corporate America.
Introduction. The essence of Buffett's wisdom. Warren Buffett's letters to Berkshire Hathaway shareholders offer an invaluable education in sound business practices, investment, and corporate management. This book condenses these insights, highlighting a central theme: fundamental valuation analysis, pioneered by Ben Graham and David Dodd, should guide investment decisions. This is coupled with management principles emphasizing that managers are stewards of invested capital and shareholders are its owners. Many of Buffett's lessons contradict conventional business school teachings and Wall Street practices. He champions a long-term, owner-oriented approach, focusing on a business's intrinsic value rather than short-term market fluctuations.
Chapter 1. Corporate Governance. Owner-related business principles. Buffett views shareholders as owner partners and himself as a managing partner, aligning his financial fortunes with theirs. Candor and transparency. Open and honest communication from management to shareholders is crucial, fostering a productive dialogue and attracting a dedicated shareholder base. Focus on people, not formulas. Managerial structure and hierarchies are less important than selecting able, honest, and hardworking individuals. CEO selection and oversight. CEOs are difficult to measure and oversee due to a lack of senior superiors and conventional board congeniality. The best solution is to carefully identify capable CEOs who don't need weak structural restraints. Board effectiveness. Boards should be small, composed mostly of outside directors chosen for business savvy and owner orientation, not prominence or diversity. Plant closings and long-term versus short-term. Balancing short-term results with long-term prospects, including community trust, is a hallmark of intelligent management, even when difficult decisions like plant closings are necessary. Owner-based corporate charity. Shareholders, not management, should designate corporate charitable contributions, reflecting an owner-oriented approach to capital allocation. Principled executive pay. Executive pay should be performance-based, measured by profitability after accounting for capital employed, and stock options are often flawed as they don't expose managers to the same risks as owners. Key takeaways. Act like an owner. Every decision, from operational strategies to charitable giving, should prioritize the long-term interests of the shareholders, treating the business as if it were wholly owned by them. Transparency builds trust. Honest and direct communication, even about challenges, fosters a loyal and informed shareholder base. Focus on the who, not just the what. The quality and character of management are paramount. Good people can overcome challenges, while even good businesses can be ruined by poor leadership. Avoid short-termism. Decisions driven solely by immediate financial results often ignore crucial long-term impacts on the business, its reputation, and its stakeholders. Compensation should align interests truly. Executive pay should genuinely mirror shareholder returns, without loopholes like stock options that reward mere capital retention rather than value creation. Practical daily example. Imagine you own a small local coffee shop. Owner-related business principles would include, instead of just looking at daily sales, you'd constantly think about ways to enhance the long-term value of your shop. For instance, would upgrading your espresso machine genuinely improve future profitability and customer loyalty, or would it just be an expensive novelty? You wouldn't pay yourself a massive salary if the business was just breaking even, because you know it would hurt your partners, your family if it's a family business, or future potential buyers of your business. Candor and transparency. Instead of hiding it from your baristas, your team, you'd explain the situation, maybe discussing how to maintain profit margins without alienating customers, fostering their understanding and buy-in. Focus on people, not formulas. Instead of implementing a rigid corporate structure with endless forms for your baristas, you'd prioritize hiring passionate, reliable individuals who genuinely care about making good coffee and serving customers. You'd trust them to handle their daily tasks without micromanagement. Plant closings and long-term versus short-term. If a particular brand of pastry consistently sells poorly, even after trying different marketing strategies, you'd eventually stop ordering it, even if it meant a temporary dip in revenue. You understand that holding on to a losing product hurts the overall health of your business in the long run. Owner-based corporate charity. If you decide to donate a portion of your profits to charity, instead of picking your personal favorite cause, you could ask your most loyal customers for suggestions, recognizing that their continued patronage is part of the business's success. Principled executive pay. If you had a manager, you wouldn't give them a bonus simply because the coffee shop's revenue increased due to a general rise in coffee consumption across the city. You'd tie their bonus to specific metrics they control, like customer satisfaction scores, efficiency in ordering, or successful implementation of new menu items.
Chapter 2: Corporate Finance and Investing. Critique of Modern Finance Theory. Buffett strongly refutes efficient market theory, EMT, and modern portfolio theory, MPT, arguing that thinking about individual investment opportunities is valuable and that volatility does not equate to risk. Mr. Market Allegory. Ben Graham's Mr. Market concept illustrates the irrationality of the stock market, acting as a manic-depressive partner offering daily buy-sell prices which investors should exploit rather than be guided by. Margin of safety. The core principle of sound investing is buying a security only when its price is substantially lower than its intrinsic value, providing a buffer against errors and misfortunes. Value investing is redundant. All true investing is inherently value-based, seeking to pay less for an asset than it is worth. Anything else is speculation. Concentration versus diversification. While diversification is crucial when understanding is limited, for example, index funds for know-nothing investors, for know-something investors, concentration in a few well-understood businesses can reduce risk and enhance returns. Transaction costs as a tax. Excessive trading activity incurs significant transaction costs, commissions, spreads, and taxes, which act as a tax on investors, eroding long-term returns. Arbitrage as cash management. Buffett engages in arbitrage when opportunities arise from publicly announced corporate events, viewing it as a short-term alternative to holding cash equivalents, but only when the odds are favorable and information, not rumor, is key. Institutional imperative. This unseen force can lead to irrational business decisions, such as resistance to change, absorption of funds in suboptimal projects, and mindless imitation of peers. Junk bonds and financial alchemy. Buffett criticizes junk bonds and financial structures that prioritize revenue generation over financial sense, often based on flawed assumptions and leading to disastrous outcomes for investors. Preferred stock as a strategic investment. Preferred stocks are analyzed for their fixed income characteristics and potential for common stock conversion, with the success hinging on good management and industry conditions. Key takeaways. Think like a business owner, not a market trader. Focus on the long-term economic prospects of a business, not daily price fluctuations. Price is what you pay, value is what you get. Always seek to buy something for less than it's worth. Beware of financial fads and sophisticated theories. Simple common-sense principles often outperform complex, academically driven strategies. Patience is a virtue. The best investment opportunities often arise during periods of market fear or irrationality. Stay within your circle of competence. Invest only in businesses you understand thoroughly. Practical daily example. Imagine you are looking to buy a used car. Mr. Market allegory. You go to a car dealership and the salesperson, Mr. Market, gives you a wildly fluctuating price for the same car each day based on their mood or how many people walked in that morning. One day they're euphoric, asking for a premium. The next they're depressed, offering a huge discount. An intelligent buyer wouldn't be swayed by their mood, but would have an independent assessment of the car's true value, its condition, mileage, model year, market comparisons, and only buy when Mr. Market offers a price below that assessed value. Margin of safety. When negotiating for the car, you wouldn't pay the exact fair market value. You'd aim to buy it at a price significantly below what you believe it's truly worth. For example, if a car is worth $10,000, you'd aim to buy it for $7,000 or $8,000. This margin of safety protects you if you discover unforeseen issues after the purchase, like needing new tires or a minor repair, or if the market for that car model suddenly dips. Value investing is redundant. You wouldn't categorize yourself as a value car buyer just because you prefer good deals. All smart car buyers are looking for value.
If you're buying a car hoping someone else will pay more for it tomorrow without assessing its underlying utility or condition, you're speculating, not investing. Concentration versus diversification. If you're a mechanic and know a lot about a particular car brand, you might concentrate your investment by buying 2 or 3 cars of that brand, knowing you can easily assess their true condition and fix any issues. A know-nothing car buyer, on the other hand, might be better off buying a diverse portfolio of cars through a reliable dealership with a good warranty rather than trying to pick individual cars they don't fully understand. Institutional imperative. Your neighbor recently bought a brand new, very expensive SUV that they don't really need just because everyone else in their social circle is buying one. This is like a company mindlessly imitating its peers' acquisition strategies, even if it doesn't make economic sense for them. Junk bonds and financial alchemy. Someone tries to sell you a very cheap used car that has been reconditioned with a lot of cheap aftermarket parts and an unrealistic financing plan that requires you to constantly refinance your loan just to make the payments. The seller emphasizes how much you could sell it for in a few months, ignoring the real cost of the repairs and the fact that it's probably going to break down.
Chapter 3. Common Stock. Long-term ownership mentality. Buffett and Berkshire Hathaway aim to attract shareholders who think like long-term business owners, not short-term traders. Intrinsic value versus market price. The goal is for Berkshire stock to trade at or around its intrinsic value, avoiding significant overvaluation or undervaluation, which ensures that business results benefit those who owned the company during that period. Minimizing transaction costs. High stock turnover incurs substantial costs, commissions, spreads, taxes that effectively act as a tax on owners, diminishing long-term returns. Dividend policy principles. Earnings should be retained only if they can be reinvested to create at least $1 of market value for each dollar retained. Otherwise, they should be paid out as dividends. Stock splits are detrimental. Stock splits increase transaction costs, attract short-term, market-oriented shareholders, and can lead to prices that deviate from intrinsic value, offering no offsetting benefits. Recapitalization to counteract clones. The creation of Class B shares was a strategic move to offer a low-denomination option to smaller investors, thereby blunting the merchandising efforts of expense-laden unit trusts that mimicked Berkshire's performance but imposed high fees and fostered speculative behavior. Honest disclosure on valuation. Buffett openly stated that even the newly issued Class B shares were not undervalued at their offering price, reinforcing the message that Berkshire is for long-term investors focused on business value, not short-term price appreciation. Key takeaways. Your holding period should be forever. Approach stock ownership as if you are buying a piece of a private business you intend to own indefinitely. Avoid necessary trading. Minimize transaction costs by focusing on long-term ownership of quality businesses. Retain earnings wisely. Companies should only retain earnings if they can generate superior returns on that capital. Otherwise, it should be returned to shareholders. Don't chase fads or superficial metrics. Stock splits and high trading volume don't create value. They often just shuffle money around and generate fees for intermediaries. Integrity in capital allocation. Managers should always act in the best interests of their shareholders, even if it means unconventional decisions regarding stock issuance or dividends. Practical daily example. Imagine you own a highly successful, very expensive antique grandfather clock that appreciates significantly in value each year. Long-term ownership mentality. You bought it because you appreciate its craftsmanship and historical value, and you expect it to continue appreciating. You aren't constantly checking auction house listings to see if you can flip it for a quick profit. You view yourself as its steward. Intrinsic value versus market price. If antique clock prices suddenly surge due to speculative frenzy, making your clock's market price far exceed its true intrinsic value, what a rational collector would pay based on its historical significance, condition, and rarity, you wouldn't feel compelled to sell.
you'd recognize the market is being irrational. Minimizing transaction costs. If a friend constantly suggests you trade up to a slightly different antique, incurring appraisal fees, transportation costs, and potentially dealer commissions, you'd resist. These transaction costs would eat into your overall appreciation from your original, perfectly good clock. Dividend policy principles. If your grandfather clock somehow generated earnings from occasional museum rentals, you'd only reinvest those earnings into restoring the clock if that restoration truly enhanced its long-term value and marketability by more than the cost. Otherwise, you'd pocket the earnings. Stock splits are detrimental. Stock splits increase transaction costs, attract short-term, market-oriented shareholders, and can lead to prices that deviate from intrinsic value, offering no offsetting benefits. Honest disclosure on valuation. If you decided to sell a small fraction of your clock, say, a specific decorative element, you wouldn't exaggerate its potential future value. You'd honestly state what you believe it's worth at that moment, even if it's not a screaming bargain, to attract buyers who appreciate its true artistic merit and are in it for the long haul.
Chapter 4. Mergers and Acquisitions. Avoid toad kissing. Many managers are overly optimistic about acquiring struggling businesses, corporate toads, at high prices, hoping for wondrous transfigurations that rarely materialize. Instead, focus on buying good businesses at fair prices. Bad motives for acquisitions. High-premium takeovers are often driven by managerial thrill, desire for enhanced size, and excessive optimism about synergies, rather than shareholder value creation. Issuing stock for acquisitions. Berkshire issues stock only when it receives as much intrinsic business value as it gives. Many companies make the mistake of using undervalued stock to acquire fully valued businesses, effectively giving up more value than they receive. Sensible stock repurchases. Buying back undervalued stock is often the best use of capital, immediately increasing intrinsic business value per share and demonstrating pro-shareholder management. Greenmail is reprehensible. Buffett condemns greenmail, or repurchasing stock from hostile bidders at premium prices, as corporate robbery, where existing shareholders fund a payoff to an extortionist. Critique of leveraged buyouts, or LBOs. While LBOs can benefit from tax effects, they often weaken corporations with excessive debt, prioritize short-term cash generation, and raise overall acquisition costs, leading to a greater fool game where buyers pay irrational prices. Sound acquisition policies. Berkshire's approach is characterized by not having a strategic plan that forces acquisitions, instead constantly comparing potential deals to other opportunities, like buying marketable securities. They seek simple, understandable businesses with consistent earning power, good returns on equity, and strong management in place. Selling one's business to Berkshire. Buffett offers a unique proposition to sellers. Berkshire buys to keep, offers extraordinary managerial autonomy, and allows sellers to remain involved. This contrasts with most buyers who either integrate and change the business or flip it for a quick profit. Key takeaways. Don't overpay, no matter how good the business. Even a prince can become a poor investment if bought at an exorbitant price. Acquisitions are often value-destroying. Be highly skeptical of merger and acquisition activity, especially when it involves issuing undervalued stock. Capital allocation is critical. Managers' decisions on how to deploy capital, whether through acquisitions or repurchases, profoundly impact shareholder wealth. Prioritize long-term stability and integrity. Seek partners, both managers and co-investors, who share a commitment to the enduring health of the business. Practical daily example. Imagine you own a very successful small bakery and are considering expanding. Avoid toad kissing. A real estate agent tries to convince you to buy a rundown, failing bagel shop in a bad neighborhood, insisting that with your magical touch, managerial kiss, it will be a huge success. You resist, knowing it's better to invest in another good location than try to revive a lost cause. Issuing stock for acquisitions. You have a unique, highly profitable bread recipe that makes your existing bakery very valuable. A competitor offers to merge and wants you to give up a large percentage of your profitable bakery in exchange for a small percentage of their less profitable, less unique business. You refuse, realizing you'd be giving up more value than you're getting. Sensible stock repurchases. If your bakery is a corporation and its stock is trading very cheaply compared to its actual value, for example due to a temporary market downturn, instead of buying another less attractive bakery, you'd use your excess cash to buy back your own stock. This immediately increases the ownership stake of remaining shareholders in your highly profitable business. Sound acquisition policies. Instead of having a rigid, strategic plan to open a new bakery every year, you constantly assess all opportunities. Is it better to open another bakery, invest in new equipment for your existing one, or maybe even invest in a small, profitable local coffee shop, a marketable security, if it's selling at a fantastic price? You only act when it makes the most sense for your long-term wealth, not because of a preset expansion goal.
Chapter 5. Accounting and Taxation. Accounting as a form, not the truth. Financial statements are a form that can be manipulated and do not always reflect true economic reality. Investors must look beyond reported numbers to calculate true economic earnings. Look through earnings. This concept provides a more accurate picture of economic performance by including Berkshire's share of undistributed earnings from investee companies, recognizing that value is created by how earnings are deployed, not just by dividends received. Economic goodwill versus accounting goodwill. Accounting goodwill, the excess of purchase price over tangible assets amortized over time, is distinct from economic goodwill, intangible assets like brand recognition that allow a business to earn above-average returns. Economic goodwill tends to increase with inflation, while accounting goodwill diminishes. Amortization of accounting goodwill should be ignored when evaluating a business's operating results and acquisition wisdom. Owner earnings and the cash flow fallacy. Owner earnings, operating earnings plus non-cash charges minus necessary capital expenditures to maintain competitive position and unit volume, is a superior metric to cash flow, often just operating earnings plus depreciation, as the latter often overstates economic reality by ignoring crucial reinvestment needs. Intrinsic value is key. Book value and market price are limited. Intrinsic value, discounted future cash flows, is the ultimate determinant of a business's worth, although difficult to calculate precisely. Book value and market price are often of limited use and can significantly diverge from intrinsic value. Retiree benefits and stock options as real costs. Accounting rules often allowed companies to understate liabilities for post-retirement benefits and stock options by not recognizing them as expenses. Buffett argues that any compensation, whether cash or options, is a real expense that should be reflected in earnings. Taxation and long-term investing. Long-term investing offers significant tax advantages by deferring capital gains taxes, allowing capital to compound untouched for longer periods. Key takeaways. Don't be fooled by accounting tricks. Always dig deeper than reported numbers to understand the true economic performance of a business. Cash flow isn't always king. Understand that a business needs to reinvest to maintain its competitive position, and this cost must be factored into its true earnings. Focus on what matters. Intrinsic value, driven by future cash-generating ability, is the most important metric, even if it's imprecise. Be skeptical of unacknowledged liabilities. Hidden costs, whether from retirement benefits or stock options, can significantly erode shareholder value. Taxes impact returns. Understanding tax implications is vital, and delaying taxes through long-term holding can significantly enhance after-tax returns. Practical daily example. Imagine you run a small but growing software company and you're reviewing your financial performance. Accounting as a form, not the truth. Your accountant presents a glowing report of your profits.
However, you know to make the numbers look good, they've capitalized a lot of software development costs that in reality are just ongoing maintenance and minor upgrades. You understand that this manipulation makes your true economic profit lower. Owner earnings and the cash flow fallacy. Your sales team is pushing for a new CRM system. The sales pitch emphasizes the cash flow it will generate. However, as the owner, you know that a significant portion of that cash flow will need to be immediately reinvested in training, IT support, and future upgrades just to keep pace with competitors and maintain your current client base. Your true owner earnings, what you can actually take out of the business without hurting its long-term viability, are much lower than the hyped cash flow. Economic goodwill versus accounting goodwill. Your software has a fantastic reputation and a loyal customer base, allowing you to charge premium prices. This is your economic goodwill. If you were to sell your company, a buyer would pay a lot for this intangible asset. Your accountant, however, might only show a small accounting goodwill on your books from a past acquisition, which is slowly being amortized or written off. You understand that the actual value of your brand, economic goodwill, is much greater than what's formally recorded. Retiree benefits and stock options as real costs. You consider offering stock options to your key developers. Your HR consultant downplays the cost, saying it's not cash out of your pocket, but you realize that these options represent a real future claim on the company's value, a form of compensation that should be accounted for as an expense, just like their salaries. Taxes and long-term investing. You have some extra cash. Instead of frequently buying and selling short-term investments, incurring capital gains taxes every time, you choose to invest in a long-term, high-quality stock. You understand that by delaying the realization of gains, you allow your money to compound untaxed for a longer period, significantly increasing your eventual after-tax wealth.
Overall book summary. The Essays of Warren Buffett advocates a profound yet simple investment philosophy. Treat stocks as ownership in businesses. Rejecting speculative fads and complex theories, Buffett champions fundamental valuation, emphasizing a margin of safety in purchases. He stresses integrity in management, aligning executive interests with long-term shareholder value and transparent communication. The book critiques accounting practices that obscure economic reality and highlights the power of patient, focused investing, where understanding a business and its long-term cash-generating ability far outweighs market volatility or short-term gains. It's a timeless guide to rational capital allocation and enduring wealth creation.
If you enjoyed the content, please consider supporting the author.
Thanks for watching, and if you like this video, subscribe. Now, let's go to the next video.